The liquidity is just simply not there, which is why it's sort of hurdling up $1 at a time at the moment. This is a squeeze on the system. And, this is very serious. And I think so, I can understand your punter selling off, $1,000 below the current level and maybe living to regret it. Bruh. But, I can understand that. But the bit he's missing basically is he's going to be out of the market on the biggest, sharpest squeeze probably seen in history. I think that's where we're headed.
In today's news recap, Bank of America hikes gold price forecast to $5,000 per ounce for 2026. Bank of America Global Research on Monday raised its price forecasts for precious metals, lifting its 2026 outlook for gold to $5,000 an ounce, with an average of around $4,400. Gold surged above $4,000 an ounce for the first time ever on October 8th. Gold prices scaled to another record high at $4,079.62 on Monday as investors revved up their safe haven bets after U.S. President Donald Trump renewed tariff threats against China, while expectations of U.S. interest rate cuts added to the metal's allure. The bank sees the risk of a correction near term, but still expects a further upside in 2026. Looking into 2026, a 14% increase of investment demand, similar to what we have seen this year, could lift gold to $5,000 per ounce, the bank noted. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
Now, let's look at the demand side. So far, this hasn't mattered because nobody wants to buy gold. I mean, any investment manager isn't going to earn fees by putting his punters into gold. He would rather put them into something which is going to pay him a bit more. And not only that, but the regulators are on his side. The regulators turn around and say that, physical metals are not regulated investments. But of course, this was why they set up ETFs, to get around this regulatory hurdle. But the ETFs are beginning to grow. People are beginning to buy into them slowly. But the other thing, which I think is very important on the demand side, is that we now see analysts at the major US banks turning around and saying, we believe gold's going at 4,000, whatever their reasons. I don't care. I mean, they don't know what they're talking about. I reckon that's my default assumption anyway. But, the fact that they are saying it, and the fact that the investment managers within those banks, who are typically managing or responsible for over $1 trillion, we're looking at banks like Goldman Sachs, Bank of America, Citibank, Citicorp, whatever they call themselves now, etc. We're talking about huge numbers. They haven't got any. I don't think they necessarily know how to get it, actually. I mean, so that, this is interesting. When you look at the complete investment management universe around the world, it is estimated that portfolios are worth some $300 trillion. $300 trillion. Now, gold ownership of that, you just look at ETFs and maybe sort of make a few assumptions about, bullion being stored and so on. But, basically it's ETFs and nothing else. It's less than 0.5% of that. I mean, it really is. Less than 0.5% is in gold. And yet you've got these behemoths in America now thinking, oh, we better buy some of this. Now, to put it into context, my China story suggests that the amount of liquidity, which is unspoken for, including jewelry in the West, is probably in the region of about 40 to 45,000 tons. That's all. That's it. We can see what's in the vaults. We can't see what's in the Swiss vaults. That's something I don't know. I would, someone gives me a number, it'd be super. But I think quite sensibly, the Swiss don't produce these numbers. That's what I would assume anyway. But it does mean that if a 1% increase in allocation, portfolio allocation of that 300 trillion was to take place at current prices, you're looking at 25,000 tons. Where's it going to come from? I mean, the answer basically is that we're heading for the most enormous crisis in the gold market. And the figures are very different for silver because being an industrial metal, etc., but the same principle applies. The liquidity is just simply not there, which is why it's sort of hurtling up $1 at a time at the moment. This is a squeeze on the system. And, this is very serious. And I think so, I can understand your punter selling off, $1,000 below the current level and maybe living to regret it. But, I can understand that. But the bit he's missing basically is he's going to be out of the market on the biggest, sharpest squeeze probably seen in history. I think that's where we're heading.
In today's news recap, gold has hit peak trendiness, analysts suggest. The record gold rally of the past few months may have peaked in trendiness. A top investment bank has predicted, despite the precious metal hitting fresh highs on Monday, fueled by Donald Trump's threat last week to upend trade with China. Deutsche Bank said that while it was not predicting an impending correction, the length and intensity of the yellow metal's upturn has made a period of more neutral behavior more likely. The gold rally of September-October may have peaked in trendiness. Deutsche Bank analyst Michael Shuey wrote in a note, trending episodes have lasted on average for 19 days in the past 3 years. So the current episode of 29 days and counting is longer than median and average. Fears over Western governments' ballooning debt piles and a flurry of political crises helped carry the price of gold past $4,000 per troy ounce last week. Little more than 6 months since it cleared $3,000 for the first time in March. The spot price of the precious metal, a safe haven asset traditionally used as a hedge against inflation, has risen more than 22% since August, alongside striking gains to Bitcoin and other cryptocurrencies. The rally has been dubbed the debasement trade by some because of fears among investors that governments will look to devalue their currencies as a means of inflating away debts. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
And, anyone who's left holding the fiat baby is, basically has had it. That's what's going to happen. So that, I think, is the background. But the interesting thing is that the Chinese, who are a bit old-fashioned over these things, they didn't have the benefit of John Maynard Keynes teaching them economics, etc. They came out of communism, if you like, with the belief that the capitalist system would fail. And, of course, the failure of the capitalist system, would be through its currency. And so they started accumulating gold, really, shortly after Mao Zedong passed away. And I've got an English copy of the regulations dated 1983, appointing the People's Bank of China with the sole responsibility for managing and acquiring the nation's gold and silver reserves. And this is terribly important. It's important to know this. The second thing to know is that no one in China was allowed to own gold until it was legalized in 2002. And that was the point where the Shanghai Gold Exchange opened, which facilitated the delivery of gold to the public. So we had this period between 1983 and 2000 when China state acquired gold. And so where did it come from? Well, we had a massive bear market between those dates. And not only that, but, it was quite clear that quite a lot of central bank gold held in the West had actually gone out on lease, never to be returned. This was estimated by Frank Federosa to be somewhere between 10 and 14,000 tons. In other words, between a third and a half of all central bank gold was out on lease, sold into the market, and not coming back. Now, Federosa reckoned that it was probably adorning the necks of Asian women. I think it's another story. I think the People's Bank of China was in there quietly picking it up. I estimate, now I have no firm figures on this at all, and I have to say that the thing about the gold market, as we all should know, is that nobody wants to say that they actually own any gold. They want to keep it secret. And I'm not talking about individuals, I'm also talking about governments. And this is the whole thing. The US government is a prime example. I mean, we keep on wondering how much gold they've actually got, and what do they say? Nothing. I reckon that they'd accumulated roughly 20,000 tons between 1983 and that year, 2002. Now, since then, of course, the Chinese government has continued to accumulate gold. Not only that, but mine output is the thick end of 10,000 tons. I mean, China invested hugely in its own gold mine production and rapidly became the largest producer nation by far, eclipsing South Africa, which was declining quite rapidly as it happened back in the, I suppose, sort of 1990s and into the early noughties. And the other thing, of course, is that state-owned refiners were bringing in doré from abroad. I mean, particularly, obviously, Mongolia, and paying them for the doré. And where did the gold go? Didn't leave China. I mean, as far as the relationship between gold and China is that China is Hotel California. It comes in, that's no problem at all, but it can't get out. So that has been the policy. Why is it this policy? It's this policy because the Chinese understand the importance of gold. Now, since the SGE opened, over 27,000 tons of gold has been delivered into private hands. Now, some of that would have returned into the Baltic system as scrap. But I don't care, because that just gets redistributed elsewhere. It's not going out of China. Never has done.
No.
And on top of that, of course, you've got the banks. The banks run gold accumulation plans for their depositors. And this gold is not delivered out of the Shanghai Gold Exchange. It is stored within the Shanghai Gold Exchange. So we don't know how much gold there is there. But I should think it's quite a lot. I pencil in a figure about 10,000 tons. Now, I think that might underestimate the situation for the very simple reason that household savings rate is in the order of, it's over 30%. And that's the equivalent of $5 trillion a year. Now, it used to go into off-plan apartment buildings and stuff. That's gone. Let's forget that. Stock market, maybe a little bit, but I think that's got very, very limited appeal.
What do you think of Macleod's take? Will gold continue to rise in the fourth quarter of 2025 and beyond? Are we approaching a major top in the global markets? Post in the comments section down below your honest opinion. Subscribe if you have not yet done so. And check this video right here because it's a perfect fit for you, and I'll see you on the other side. Thanks for watching.